So what exactly did Federal Chairman Powell say on Friday that the markets liked? Because we saw the Dow Jones shoot up over 300 points on Friday after he spoke. Today, the futures market are showing that the stocks are going to continue that rally, and mortgage rates came way off their peaks. So that's what we're going to talk about today. My name is Dan Frio. I do this report on a daily basis to help you guys figure out what's going on in real estate. I don't talk about home prices because they're all over the map. If you're in the West Coast, you might be a little concerned. Prices are coming down. If you're on the East Coast, prices are stagnant. They're not doing anything. If you're in the middle of the country, you're actually seeing nice little appreciation, kind of the norm, about 4 and 5% rallying through the markets. So what happened last week is Federal Chairman Powell, he spoke in front of the world, basically, and he said a few things. And here's what the captions say. Federal Chairman Powell calls inflation too high. And if you notice all the Federal Chair people who sit on the Federal Reserve, they all come back with these same words. Kind of freaks me out because verbatim, they're saying the same words. But if you really focus in on what Federal Chairman Powell said on Friday, it might give us a little glimpse on what they plan to do. So basically baked in the cards right now, everybody's saying there's one more rate hike coming. Don't expect it in September, so that means it's got to be in November or December, right? Well, even the Fed says they're data dependent. But what I want to show you guys or want to point out is 3 things that he said that made me go, I wonder if everybody picked up on this, and I think they have. The first thing is we want to see is he mentioned something about uncertainty about the lags. Okay, so what that means is the Federal Reserve has raised rates exponentially, basically more than they've ever done in history. Okay, so now he's finally coming back saying, well, we know there's lags in what we do, or there is lags in what they do, and we're going to wait a little bit for those to kick in. So that one piece of the puzzle tells me, well, they're probably going to hold off for now. The next thing is he says there's significant drag in the pipeline, meaning there's a lot of things going out there right now. And again, it's like another comment that he made, uncertainty about the lags, is it's going to take time to turn this thing. So think of it, if you're in a speedboat and you want to turn the boat, you just go, whoo, and it goes, zoom, you can do a 360. However, if you have a cruise ship, you turn the wheel, and it's going to take a while for that cruise ship to turn around. So there's lags there. So all these things that the Federal Reserve has been doing, they've caused interest rates or the inflation rate to go from 9 to 3. It's kind of like saying, well, I was 300 pounds and then I want to get down to 200 pounds. Well, you've done this and you're in it for about a year and a half, and now you're at 230. Well, you can't say, it's victory, but you got to say, well, my eating habits and my workout habits are really working. Do I have to cut my food consumption and double up my workouts because I want to get there quicker? Could that have cause and effect on my health? I hope you get what I'm saying. So what the Fed needs to do is they need to sit back, because even in their words, it takes about 2 years for these lags to go in and take into effect, because their concern is right here. They do too much. This is his last third statement. We want to make sure we don't do too much to mess up and overshoot. So what's happened over the last 5 recessions, what's caused it is the Federal Reserve stepped in, they raised rates, kept continuing to raise rates, and they pushed us into a recession. This time they're like, why isn't there a recession? We've been doing more things than we've ever done in basically history. Why is there no recession? Why are people not losing jobs? Well, let me say one thing. Stimulus packages. There's still hundreds of trillions of dollars out there in stimulus money still needing to work its way through the systems based on the infrastructure bill, the Green Act, and all kind of other things out there. So there's still a bunch of money being pumped into the economy. When you're pumping all this money into the economy, you can't expect inflation to drop substantially. So that's my tirade of the day. So based on that information that the federal chairman gave us on Friday, what's the expectations now that the Federal Reserve is going to raise their rates? So we go over to the CME FedWatch tool, and this is getting headlines all over the place. I started talking talking about this about 6-8 months ago, and now a lot of people are talking about this as well. So the Chicago Mercantile Exchange, they have a tool, and it's right here. What the Federal Reserve is going to do at the next meeting. What do they do right here? What is the likelihood the Federal Reserve will change the target rate at the next FOMC meeting? So the target rate, or basically what the Federal Reserve controls, is one interest rate. It's the federal funds rate. Right now, that rate's at 5.25, between 5.25 and 5.5. So where are things right now? Well, we are 5.25 to 5.5. That's where we are right now. There's an 80% chance that we're going to stay there at the next meeting. So when and where do they think that their mortgage rates are going to increase? Well, now it's saying November and December, those moved up. Now there's basically a 50-50 chance. This changed the other day, guys. There's almost a 50-50 chance here that between November in December, the Federal Reserve is going to raise rates. So what you're seeing right here is the meetings, the probability of what they're going to do at the next meeting. Right now, like I said, federal funds rate is 5.25 to 5.5. So in this cell right through here. Okay. So in November, well, September, they're not going to do anything. Well, at least it says that. And then November and December, each one of those is almost a 50% chance that they're going to increase it. Now, this is big adjustments from where they were, but let's look back and let's go forward. Not back. Let's go forward into 2024. Now they're saying that rates are going to be, go back to 5.25, 5.5. Okay. And then they're expected to pivot approximately mid-year, they're expected to turn around and start reducing rates. Now, this chart is the probability from the Chicago Mercantile Exchange. Let's see what the Federal Reserve themselves are saying. So if you're new to my channel, I talk about this on a daily basis, and I want to show you what the dot plot is. What the dot plot is basically every time the Federal Reserve meets, all the members basically put a dot on where they expect the federal funds rate to be. So right now, they're expecting the federal funds rate to be 5.5 to 5.75. So that's why everybody's expecting in November or December the Federal Reserve to raise rates one more time. But let's fast forward out to about 12 or 16 months from now, where a rate's supposed to be. Well, their dot plot is right through here. Where's the most dots? 4 right through here. 4 to 4.25. So if we go up to 5.75, and then next year they say the rates are going to be 4.25. Now this is from the Fed, folks. That means rates are going to decline between now and next year, probably about this time, 1.5%. Okay, so there's a big move, even from the Federal Reserve's point of view. This is what they're telling us. So let's get over to the economic calendar for the week, because this week is action-packed with news. So every day I'm going to come out and tell you, what the news came in as, what my expectations were for that news, and what it's doing to mortgage rates, because that's what we follow here on the channel. So on Monday, there's nothing. Tuesday, we have a lot of things coming in. The JOLT numbers. What the JOLT number is how many people basically how many job openings there are. That's the job openings, and the JOLT, that figure. How many job openings there are? Well, it's supposed to increase. This is going to drive the Fed nuts, but there's more data coming in throughout the week. The next thing is we see ADP non-farm payroll numbers. That's coming in on Wednesday, and GDP. GDP is supposed to, the last reading came in at 2. They're expecting it to come in at 2.4. This is another area that the Federal Reserve, I think, is missing. They're seeing that there's a lot of stimulus money out there, and there's a lot of production taking place right now. And when production goes up because the world needs stuff, that means people need to go back to work. So can this be a Goldilocks situation for the Fed, where we basically have high interest rates, but we have employment still at really good numbers? Because, guys, we've never been in this situation before. The world has never been locked down. There hasn't been this much stimulus money ever in history pumped out there. So even the economists are learning during this time frame. Then we're having pending home sales and crude oil inventories. And then we start getting into the nitty gritty. Look on Thursday, the PCE. That's basically the inflation number that the Federal Reserve gives the most weight to. So that's coming out this week on Thursday. And then we have on Friday, we have more employment numbers and everything else. So the Federal Reserve has 2 mandates. And I want to explain those 2 mandates and why this week is so important. The 2 mandates, and the reason why they were created, is for full employment, to keep the economy as robust and as many people working as possible. Okay. And 2 is price stability, AKA inflation. If you go through today's this week's numbers, we have the inflation numbers with the PCE. We have the jobs numbers based on the JOLT index. We have the jobs numbers based on the ADP payroll. We have job numbers when it comes to initial jobless claims, average hourly work, non-farm payrolls. So this week's data is full of what the Federal Reserve is really concentrated on, and they're going to pay great attention to this data. And we will as well. And I'm going to give you each day with the context as it comes in, how I can extrapolate that to the markets and what I expect interest rates to go from here. So without further ado, based on the news that we have today, which is basically nothing, what's going on in the markets? So this is the screen I have on one of my screens all day long. Why? Is because I want to focus in on rates, where rates are going, because I focus in on rates and mortgage programs to help you guys, if you're looking to get into a house, maybe it's your first home, maybe your first rental property, to help you navigate this scenario. So who am I? What do I do? Well, my name is Dan Frio. I'm a mortgage advisor licensed in all 50 states as well as Puerto Rico. I'll give you my information at the end of this video. If you're out there looking to get maybe pre-qualified to buy that first house or investment property, maybe you're out there and you're like, hey, I got a ton of bills, but I got a ton of equity in my house. So instead of paying 25% interest on my credit cards, how about I get a home equity loan? Or what a lot of people are doing right now, especially seniors, they're struggling. Inflation is astronomical. The drug prices keep going up and up and up, and they're stuck on that one payment. They might have just a pension, maybe a pension and Social Security, and they're really struggling. So if you're out there and you need to talk about possibly a reverse mortgage, before you turn the dial, don't turn it. I bet you 90% of what you know about a reverse mortgage is inaccurate. So if you're looking for a reverse mortgage, I'd love to help you with that because I specialize in those as well. So what you're seeing on your screen right now is we focus in on right here, this cell right here. Why? Because it's the MBS market. That is the mortgage-backed security market. It's a bond that trades on Wall Street that's yield is the biggest component of your mortgage rate. We don't follow the 10-year treasury. We don't follow the 2-year treasury. We don't follow any other bond yields. We follow the mortgage-backed securities, okay? Right here, this is telling us where the price is. This is the adjustment for today. If you squint, you're going to see it's plus. We haven't seen plus. Well, we saw it on Friday, but we don't see a lot of pluses. What do I mean by that? You might say, Dan, that means rates are going up. Nope. What it means is as the price of this bond right through here, as the price of this bond goes up, the yield goes down. Okay, there's an inverse. There's a yin-yang relationship. We love when the price of the bond goes up because it drives down rates. Don't see that very often, but today and Friday we did, bringing rates down to where we were about a week or two ago. Where are rates? Well, these are rates that are published by Mortgage News Daily on a daily basis. These are the top 6 products people use when they're buying or refinancing a property. Let me give you this scenario behind this because you might say, Dan, that's not the rate you gave me. Well, let me explain how this works. There's 5 criteria based on this information and these rates. Those 5 criteria are the borrower is buying their first house, it's going to be their primary home, and it's a single family home. So those 3 things. You might say, Dan, that's me. Cool. The next thing is they have a 740 credit score. Is that you? Some people yes, some people no. Now the last criteria is they're putting down 20%. Is that you? Most likely not. In today's world, people are looking to buy a house with the least amount of money down. A lot of programs are 0% down. Like if you're a veteran, God bless you. Thanks for serving. We'd love to help you use your VA benefits. Only 12% of veterans use their VA benefits. Do you know you can buy a house with no money down? Or if you're looking in a rural area, USDA, it's kind of a little bit tough to get every once in a while because you have to find a house that's USDA eligible. Your income has to fit the USDA eligibility, your credit scores, and a whole bunch of other things, but we can help you with that. So that's what we're out there assisting people with. So these are the top 6 programs people use when they're buying or refinancing a house. If you want to kick the tires and say, what do I qualify for? Dan, how can you help me? Well, do me a favor. Go to therateupdate.com. We changed the format a little bit. You go down through here. There's mortgage calculators. You can apply now. You can do a whole bunch of things. And if you speak or read in Spanish, you can click the button right now, right over here, and that'll translate everything into Spanish. But if you're looking to get pre-qualified or reach out to us for some assistance, hit the Apply Now button. It's right over there. What it's going to do, it's going to go through a few questions with you. Based on how you answer those questions, it's going to say, okay, let's schedule an appointment for you so we can talk you through this entire process. Or if you'd like to just give us a call or reach out to me directly, go to the bottom of this. You're going to find out all that information. First thing, if you want to give us a call, please give us a call. It's 800 number, 844-775-LOAN. That's 844-775-5626. Or you can reach out to me. Just email me at Dan at therateupdate.com. Thanks so much for watching, guys. I'm going to ask you to do 2 things for me today. If you find value in this video, please give me a thumbs up. And if you haven't yet, you haven't subscribed to my channel and you'd like to, please hit the subscribe now button down below. So every time I post video, you get an alert. Thanks so much for watching, guys. God bless. Leave any comments you have down below because I answer, or I at least try to answer every comment that you guys post. Take care. Have a fantastic day. Bye-bye.